We're going to watch over the weekend. So let's talk about our favorite movie theatre, PVR. On to an exclusive now. CNBC TV 18's Ronojoy Banerjee caught up with the brothers Ajay Bijli and Sanjeev Kumar Bijli of PVR and started by asking them about the recently acquired DT cinemas and how this acquisition will impact both their revenues and their margin performance going ahead. Take a look.
We've been actually very happy that this finally has come to an end, and we've been wanting to get this asset for a very long time. Because they're very well located. DLF is a great company. We share the similar kind of ethos in terms of quality, and we're very happy to have it. We're rolling up our sleeves now to make it into a PVR circuit.
What will DT Cinema contribute in terms of your revenue growth going forward?
You see, revenue, the total turnover, I think, I don't remember exactly, it was about 200 odd crores. So I think
an EBITDA, 40-50 crores.
40-50 crores EBITDA. So it'll add to whatever our overall projections are for the year. But as I said, we've never been just driven by that. It's to create a circuit which is of a certain quality, and numbers follow. So numbers follow if you do a good job. Obviously, we're running a listed company. We need to get better EBITDA margins. We need to get return on capital employed. But the thought process behind the whole group has been less focus on the customer, less focus on quality, and things will fall in place.
The last financial year, I think your overall operating margin was some 17.9% or thereabouts,
EBITDA
almost
margins.
18%.
Yeah.
So in that sense, and that saw significant growth from the previous financial year. What's happening? How are you growing your margins like that? And going forward this financial year, do you see more headroom for growth?
The scale is important. This whole business is about scale. So as you grow bigger and have more screens, you start getting economies on every consumable. That is one thing to improve your margins. And secondly, I think you need to be just focused on every unit. So a lot of times you read these articles by retail companies, and I'm not being, not questioning anybody's philosophy, but that whole 80-20 principle, that 80% of your revenues should come from 20%. We never believed in it. We believe that every single unit has to make sense. So how you capitalize your unit, what is the OPEX of the unit, what is the rental that you're paying, all should give you at least 4 to 5 year payback. So every unit is important. The second thing that has happened is that earlier in our journey, there were not too many mature properties. So now what is happening is most of our portfolio, about 80% of our portfolio is mature properties. So so at any given time, like if we have 553 screens and we add another 70 screens this year, will be 620 or whatever. So you can see the mature properties will be 553. So and percentage of new properties will only be 10%, 20%. So in our earlier journey, it was 50-50, 60-40, 70-30. So a lot of properties which hadn't completely operationalized properly, the malls were not ready, they hadn't become destinations. So therefore, they were part of the portfolio. Yeah. But now all properties are 2 years old, 3 years old, 4 years old, 5 years old, 10 years old. They've all become destinations. They become matured. People have started coming. So your revenues are better. Right. So that's happened, and plus all the time it's in our DNA to make sure that no property is EBITDA negative. So we all get very worried when we look at the portfolio.
Do you have any properties that are EBITDA negative?
No, there are, but very few, luckily. Very few, and we're working
marginally, like 2 to 5% of the properties.
Yeah.
So then from 18%, there's more headroom for growth. I come back to my question.
Yeah, absolutely. And
so is there a sort of a guidance that you can give us? Maybe.
No, we don't look at giving guidance at all, because there's a lot of volatility. Yeah. But definitely all I can say is that we're relentlessly working to improve the margins all the time.
So typically you open about 70 new screens every year, as you mentioned. Will this financial year be pretty much the same, or do we see you doing more?
I think we've given already, this guidance we always give. I think about 65 to 70 screens is, 100 screens are under fit out at any given stage. Even now as we speak, 100 screens are under fit out. But I think given the overall mall development, the licensing, all that sort of stuff, I think 60-70 will be a safe bet.
Yeah.